Rates are hovering near or below zero throughout much of the world today. Low rates make life difficult for income-starved investors. And worse, they have called into question the basic ability of traditional fixed-income portfolios to meet investors' expectations for income, capital preservation, and diversification. In order to fix what low yields have broken, investors must rethink their approach to building portfolios. While institutions have different time horizons and liquidity needs than individuals, their investing approach may offer insight into ways to address these challenges. Many institutions allocate meaningful portions of their portfolios to private markets and less liquid areas of credit markets, such as real estate, debt and equity, direct lending, infrastructure, special situations, stressed and distressed debt, structured credit, and long-short credit strategies to generate above-market income and return and to complement a portfolio of traditional assets. By adding such alternative sources of income and return, institutions seek to reshape their portfolios. If rates stay the same, the reshaped portfolio offers potential for a higher amount of income, but doing so requires allocating half of a traditional 40 portfolio away from traditional fixed income assets. That's a big leap for many investors, but it illustrates why they may need to think differently to reach their financial goals. Adding alternative sources of income that are less sensitive to changes in interest rates may also help protect returns if rates rise. And the reshaped portfolio may offer greater upside potential if rates fall. Regardless of whether or how much interest rates move, one thing remains clear. Allocating to alternative sources of income may help investors achieve their goals. Talk to your clients to determine the right mix of traditional and alternative strategies to fix their fixed income as they try to achieve their financial goals. Go to yourfixedincome.com to learn more.